Howdy, folks. Welcome to Liberty Call. Today is Thursday, September 21st, 2023. Hope everybody's having a fantastical day out there. Apologize for being a little bit late. Had a meeting with my baby boy. Well, he's not a baby. He's 25 going on 26. But, missed it. We missed our appointment while he was underway a few months ago. So I apologize. I was rambling on about all sorts of weird stuff. So anyways, if you are first time watching Liberty Call, glad you're here. Thank you very much. If you could give me some thumbs up, likes, shares, subscribes, follows. Hit the notification bell so you know when I go live. Let's go ahead and get into the numbers. All right, Dow Jones was down 370 points, 1.08%, closed at 34,070. SP 500 was down 1.64%, closed at 4330. NASDAQ down 1.82%, closed at 13,223. Let's see, the VIX was up 15.85% today. It's at 1751. Canada was down 2.09%, Brazil was down 2.15%, and Mexico down 1.05%. European markets, Germany was down 1 1/3, the UK was down 0.69%, France was down 1.59%, the Netherlands was down 0.89%, Spain down 1% even, Italy down 1.78%, Switzerland down 0.62%, and Portugal down 0.41%. Russian exchange is both in the red today. The MOEX down 1.59%, the RTSI down 1.44%. And the overnights, starting out with the Nikkei in Japan, it was down 1.22. Australia down 1.37. New Zealand up 0.06. One of the few bright spots. The Shanghai in China was down 0.77. The Shenzhen Component down 0.9. China A50 down 1.24. DJ Shanghai down 0.77. And the Hang Seng down 1.45. Taiwan weighted down 0.61. Ugly day, guys. But I figured this is what was going to happen after the Fed meeting. Everybody was, in a good mood yesterday. Oh, they didn't raise rates. Oh, but they're going to keep rates elevated? Really? What do you think was going to happen? I mean, seriously, inflation is still at, near 4%, double what the Fed's goal is. But anyways, all right, let's go ahead and dive into the market recap. Dow slumps as rising Treasury yields rattle the markets. Thursday, the Dow Jones Industrial Average experienced a decline, primarily driven by rising Treasury yields. Investors were grappling with the implications of a Federal Reserve signaling a higher for longer interest rate regime. This shift in sentiment followed data indicating that the labor market remained tight, raising concerns about inflation. One of the key factors influencing market sentiment was the rise in Treasury yields. The yield on the 10-year Treasury note reached its highest level since 2006. This increase in yields was propelled by a labor market report that showed initial jobless claims fell to 201,000, marking the lowest level since January. This signaled the ongoing strength of the job market and raised the potential for increased inflationary pressures. I think I've been saying this for a while. Yeah, these folks are not going to get their wish with falling rates and easy money. It can't be done. Well, it could. It just would create bigger and bigger problems. The tech sector, often sensitive to changes in interest rates, continued to face losses. The climb in Treasury yields, along with the Fed's commitment to keeping rates higher for a longer duration, weighed on tech stocks. Investors had previously driven a tech rally based on expectations that the Fed would be less hawkish, but Chairman Jerome Powell's recent remarks shifted that perception. Amazon, Alphabet, and Meta Platforms were among the biggest tech companies that experienced declines. Amazon in particular saw a more than 4% drop in its stock. Semiconductor stocks are also under pressure, partly due to rising yields and a decline led by Broadcom. Reports suggest that Alphabet was considering ending its reliance on Broadcom as its artificial intelligence chip supplier, opting for in-house chips by 2027. Broadcom's pricing for its AI chips had reportedly triggered these discussions. Cisco Systems faced a nearly 4% decline as it announced a $28 billion deal to acquire cybersecurity software company Splunk Inc. This move was aimed at diversifying Cisco's revenue stream as its core networking equipment business faced challenges from the growing demand for cloud-native offerings. The deal faced potential scrutiny from regulators, and the high price raised questions about its value. One bright spot in the markets was FedEx, which saw its stock rise over 4%. Despite a mixed first quarter report, analysts were positive about FedEx's better than expected earnings and progress in cost-cutting efforts, which were expected to lead to improved margins. In summary, rising Treasury yields and the concerns about the labor market's impact on inflation continue to influence the stock market, particularly in the technology sector. Meanwhile, FedEx's positive earnings report provided a ray of hope amid the market's uncertainties. Well, at least one company's doing okay out there. People need stuff moved around the country, so FedEx, UPS, I figure they're going to do all right. Next up, 6 reasons why corporate profits will fall 50%. And this is written by Charles Hugh Smith of Two Minds blog. Let's see what he had to say. All right. The stock market may be facing a significant correction due to several factors contributing to a potential decline in corporate profits. Number 1, revision to the mean. Historically, corporate profits as a percentage of gross domestic product have averaged around 6%. However, currently they stand at 12% of GDP, which is unsustainable in the long term. A likely scenario is a reversion to the historical average, which is about 50% lower than current levels. In the globalization's boost phase, the end of hyperglobalization that saw a massive surge in corporate profits, especially after China's entry into the WTO in 2001, has reached its peak and is now on the decline. The primary drivers behind this boost were labor and environmental arbitrage, which are no longer as advantageous as they once were. Number 3, quality and durability erosion. The pursuit of higher profits led to the decline in product quality and durability, epitomized by planned obsolescence and shrinkflation. However, this strategy has exhausted its potential, leaving little room for further profit gains. Number 4, hyper-financialization decaying. This phase of hyper-financialization that contributed to corporate profit growth is waning. Low borrowing costs allowed companies to acquire others and increase profits. However, the era of zero interest rate policy, the ZIRP, has ended, resulting in higher borrowing costs and less profit potential. Number 5, a shift in economic output. After decades of capital benefiting at the expense of labor, the balance is shifting. Labor costs are rising due to factors like unfavorable demographics, healthcare inflation, and changing social dynamics, reducing profit margins. And lastly, debt saturation. The massive increase in public and private debt, coupled with the end of ZIRP, has led to debt saturation. Households, governments, and businesses can't take on any more debt without significant consequences or cutting discretionary spending, which hampers growth. If corporate profits decline from the current 12% of GDP to 5%, a level within the core historical range, the stock market could face a substantial correction. This correction could result in a 2/3 reduction in stock valuations, primarily driven by a revision to more sustainable profit levels. The current high valuations are propped up by unique factors such as hyperfinancialization, hyperglobalization, the zero interest rates, which are unlikely to be sustained in the long run, and a return to a more profitable level. Profit levels of around 5% of GDP would still be healthy, but would significantly impact today's overvalued stock market. In summary, the stock market's high valuations are at risk due to an expected decline in corporate profits as several unsustainable factors lose their influence. This correction could result in a substantial reduction in the stock market valuations. So if it were to drop, right now, I already closed my. Oh, there it is. So the S&P 500 is currently trading at 4,300, and let's just do some quick math. 4,300 times 1/3. It dropped down to about 14.3, so that's not real good. Anyways, get that off the screen. And where'd I go? Here we are. Okay. Last up comes from the Mises Wire, article titled "It's Time for Some Debt and Entitlement Alarmism." If these blue-haired weirdos can freak out and tie themselves to or glue themselves to the ground and roadblock stuff, maybe it's time for those of us out here to have some alarmism around some real problems like debt. All right. Climate change has become a paramount concern for young Americans, particularly among millennials and Gen Z. They've been inundated with arguments and, in some cases, alarmist narratives about climate change through educational and media. Consequently, many young people are convinced that carbon-based energy sources have jeopardized their future on Earth. They've been lied to. You can go to on Reddit. There's Climate Skeptic is one of the threads, subreddits on there. It has very good data. Notably, it seems that children are being mobilized to advance the political goals of adults. Figures like Greta Thunberg from Sweden have addressed global forums, and it's a shame that they take a mentally ill person and put her out there like that. It's just not fair. Seemingly coached by adults, passionately chastising world leaders for inaction on climate change. Activists from their 20s have staged protests by gluing their hands to priceless artworks in major museums to condemn fossil fuel use. Such brave people. Montana saw a group of young plaintiffs win a lawsuit asserting that the state failed to uphold its constitutional duty to provide a healthy environment for residents. Really? You ever been to Montana? There's like nothing there. This victory is regarded as a milestone for the climate movement, possibly marking the start of a children's crusade of climate change activism. I doubt it. We'll just deport those assholes. Climate change has deeply divided Americans along political and economic lines. The current administration has allocated substantial resources to mitigate the presumed impacts of climate change, further contributing to annual federal budget deficits and accumulating national debt. Paradoxically, despite well-documented facts and projections about these deficits and escalating unfunded entitlement liabilities like Social Security and Medicare, there's limited public and political acknowledgement. The growing interest of the federal debt, set to rise significantly over the coming decades, leaves less room for in the budget for popular programs. This situation presents a glaring disconnect between youth-led climate alarmism and indifference to fiscal alarmism. While young activists readily protest climate change, they show little concern about the fiscal burden they'll inherit. This indifference might stem from the perceived existential threat of climate change overshadowing economic concerns. Responsible adults should shift the conversation with young people, making them aware of the magnitude of the fiscal burden. Young activists could channel their energies into addressing the looming federal budget and entitlement crisis, a cause of vital significance to their own generation's future financial well-being. In essence, it's time to pivot from climate alarmism to federal fiscal alarmism and educate younger generations about the economic challenges they'll face, empowering them to take action to secure their financial future. I doubt that's actually going to happen because that's something you could actually solve, like paying down the debt, being more financially responsible as a people and a country. But we'd rather focus on things that we really can't control, and they're way out there, and it's dirty carpet. Idiots. All right. Well, that's all I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time.